today we will do more bit on the application of blockchains. Now, when I say application of blockchains, a lot of people will debate on what is blockchain. So I want to mention a little bit yesterday. I learned quite a bit yesterday's dinner talk. Dr. Scott is not here. But you know, the last piece of his presentation was fascinating in the sense that, you know, a lot of times you just want to get things done, and a lot of times you have to get back to what do we want to achieve, and if we get that down, that's good. In a way that I feel like a lot of times I talk to the industry person, this is their philosophy that they get. So today we will have two very young practitioners, and two of them had a little bit of connection to China, and that's how I know them. The first one we will talk about is Ping An. Ping An Group is a leading group, leading like conglomerates in China on fintech related. It's on par with Ali. Probably you heard about Ali, but the Ping An is definitely on par with Ali. And they did this HKMA. HKMA is a Hong Kong Monetary Authority, basically central bank in Hong Kong, built a platform to facilitate the trade finance, and he was really the guy designing the build it. The second one is Braden Tobin, is working at Figure.com. Figure.com is a platform where basically initiating the HELOC product. HELOC is a home equity line of credit, right? So this is a very kind of a standardized. It's an important product in the mortgage market, where, you know, if you put all these financial institutions, credit agency putting together, share the information, you basically can streamline all the business. So my plan will ask these two speakers to present about 8 to 10 minutes about the way that they're working, and then we'll ask some very broad questions, and we'll leave probably 10 to 15 minutes for the open questions. Let's start with Frank from Ping An.
Yeah.
They have to connect to their own computer.
So as we're preparing my laptop, just a quick question. I want to do a quick survey. How many cryptographers we have in the room? Please raise your hand.
What was the question?
How many cryptographers we have in the room? 2? 1.5? Okay. So y'all are doing blockchain, but you're not cryptographers?
Wait, what's the definition?
Yeah, what's the definition?
Well, if you're asking that question, I guess you're not a cryptographer.
You might add,
Wait, hold on.
in a similar spirit.
Well, I'm looking for my mouse. Oh, I found it.
In a similar spirit to your question, you're doing blockchain and you're not a cryptographer. Just as important question, you might say, you're doing blockchain and you're not an expert in distributed consensus.
No, I think you look at the combination, right? You look at the room with like, I don't know, 30 people, and you have 1.5 cryptographer. I mean, that's, I was actually expecting a higher number, but that's fine. I only got 10 minutes, so I need to get it started. So basically, a lot of people say that, you know, the consortium blockchain, there's actually a lot of debates on the internet saying the blockchain, whether it's built as Fabric or Corda, they can easily be done with a database or digital signatures, which, by the way, digital signature is immutable proof of record. If you're really afraid of losing your record, you can just put your signature in multiple cloud spaces, because it's very unlikely for you to lose your data if you put it in Microsoft Azure and you put some data in the AWS, right? So there are a few fundamental problems with the blockchain, which I'm going to just try to find a pen. Highlight, and especially in the businesses. I think the biggest problem for the blockchain is in the business world, nobody's going to share data with nobody, and that's why I'm asking how many cryptographers we have in the room. And the second problem is with the smart contract, because smart contract, you don't have to be a computer scientist to know. All it does is just a piece of code runs in every node. And if the piece of code runs in every node, that means you need to have the data. And if nobody's going to share data with nobody, how are you going to have the data to run your smart contract? So there is a contradiction here. So in Ping9, at one point, I was from IBM. I was basically the first two guys who actually started the Hyperledger Fabric. Before Ping9 hired me in to help them to build the blockchain business. So one of the first things we realized that if we don't do some fundamental changes to the blockchain, to the old idea of a blockchain, especially for consortium, nothing's going to work out. Because it's going to become difficult for me to even convince myself of not using a database with digital signature. Immutable proof of record, right? So one thing we do really differently in Ping9 is we use a model we call a fully encrypted DLT. Means every piece of data on the DLT are encrypted. So if you look at the board here, we have two types of node, the encryption node and a data node. Data node is just the regular blockchain node where you run a consensus, you broadcast your data, and you distribute your data. But the key here is all the data, so if the data is coming from Bank A, then Bank A will use its own secret keys to encrypt the data before sending the data for the consensus. If the data is coming from Bank B will encrypt the data before sending data to the data node. And Bank C will encrypt their own data with their own secret key before distributing the data. And that is the model we use in basically all of our blockchain networks. So in the Hong Kong MA blockchain network, which Professor He mentioned earlier, is not really just a platform. We're using the blockchain to actually interconnect 14 different platforms. So we're using blockchain to create the terminology I like to use is an intranet, a stateful intranet, because you know the internet is not stateful, it's stateless, right? And I just kind of, I need to run it for the second time just to make sure that everybody understands. If the data is coming from your computer, you're going to first encrypt your data with your own secret keys before sending data to the network. So you're going to run a consensus, and the data get distributed to everyone. But nobody can see your data because they don't have your secret keys. So your data is encrypted by your secret key, so everybody got full control over their data. Hope that's clear. And you may ask here, then what's the point if you know, what's the goal? Why are we doing this? So what we really try to do is to use the blockchain to create network effect, right? Decentralization, the goal for decentralization in businesses is to create a network effect. Once you got network effect, then you can create your own ecosystem. The ecosystem is the best barrier for entrance. So that's what every business wants. And another reason we use blockchain is to make sure, we want to make sure that there is a single piece of a view, there's a single record of truth. But how to achieve that is a little bit more complicated. So what we want to do is we want to make sure is everyone on the network, whether it's party A, B, C, D, or others, they all access, view, and edit the same set of data on the blockchain. So there's a single record. And once you get that, you can actually destroy the data silos because everybody is accessing the same piece of data. If you're presenting, why is that? You give an example. So if you take the data to the tax department, if the vendor takes the data to the tax department, it's their interest to actually report a lower number because so they can pay less taxes. But on the other hand, if you take the number to the banks, they want to report a higher number so they can get more money, get more loans, get more money from the banks. But if the banks and the customs or the tax department are looking at the same data, then they have a choice to make. You either pay more taxes or you get you get less money from the banks. Either way, it's going to make your business less competitive. So, for example, a purchase order on the traditional database is going to have 4 different fields, right? These fields are going to be in a clear text. And the party A will encrypt the data with their own secret keys. And then we'll use the blockchain to distribute the encrypted data among all participants on the network. So that party A can use cryptographic protocols, and by the way, each data field is encrypted with a unique key. And that way, the party A can control, say, Party B can read or access the first field. Party C can read and access the first and the last field, and the party D can read or edit the fields 2, 3, and 4. So you use a crypto control to give the access right, whether that means the read right or the edit right of each different field, depending on their role in the network, in the data network. So by the end of the day, everybody view, access, and edit on the same data, on the same data. Single piece of view. So we want to create transparency. So once you destroy data silos, it's difficult to create frauds. If it's difficult or more expensive to create fraud, and once you achieve that, then there are many benefits. And I think the most obvious one is bank will have more confidence lending you money, and probably lend you at a lower rate. Okay, I got a key here. I'm still on jet lag from Shanghai, so it kicks in after lunch. But that's not enough. So we actually introduced what we call the 3D zero-knowledge proof protocol. It's a cryptographic protocol basically enables third parties to verify encrypted data without being able to decrypting it. So you verify the data with zero knowledge. Give you an example. If the invoice on the blockchain is going to be encrypted and going to look like that, and you have the logistic data, which is also going to be in the encrypted form. But if the bank's going to validate whether the invoice amount is accurate, he probably needs to do the check. But he cannot get the data from the logistic company or get the data from the customs. So he's going to run, the bank is going to run a check to basically use the encrypted quantity of goods they got from logistic company, multiply the encrypted unit price, and validate if the product of the two numbers can match the total amount on the invoice. So what this is, if I buy 1,000 boxes of shoes with a unit price of $100 each, I want to make sure that if the bank got an invoice says $100,000, then the seller better shipped out can show the record of 1,000 boxes of shoes being shipped out. If you only shipped out, say 500 boxes of shoes, then the most you can get is $50,000 on the invoice, right? But in this way, they can validate the accuracy of the number in zero knowledge. And once the PO actually comes second. Sorry, the flow is mixed up a little bit. The purchase order, the purchase order and the invoice, the amount of purchase order and the invoice, the ones provided by the buyer, ones provided by the seller, we can verify if these two numbers do match or not. It's probably going to be one-to-many or many-to-many relation, but by the end of the day, these two numbers better match. And the vendor can take the purchase order to get finance from Bank B. Say the purchase order worth $100,000. I can take $50,000 as a collateral to get finance from Bank A, and get another $70,000 to get finance from Bank B. But that's going to be an overspending, right? Or you're actually double financing, because you only got $100,000, and then you're taking $50,000 collateral and $70,000 as a collateral into different banks. Because their data in the traditional databases, they are basic data silos, but in the same time, the bank cannot share data with each other. So before the Bank B decides whether I'm going to finance and lend the money to this company, I'm going to make sure that if I were to do that, add to whichever the amount that has already been used for finance in the PO, it's not going to be greater than the total amount on the PO. Again, everything is validated in zero knowledge. So we're two things in the zero knowledge. We're doing zero knowledge check on the data relationships, say the number is bigger or greater or equal to each other of the encrypted data. And we're also doing zero knowledge check on fully homomorphic operations. And we can achieve that in 2 to 3 milliseconds. And in ZKP, we're basically at least, I think, 3 to 4 magnitudes more efficient than our closest competitor. Well, they want to see the data doesn't mean they have access, right? They have the right to see the data, because the data owner has the control over their data. They decide who sees the data. And, right? Okay, so this is a quick example on the network. Okay, only 2 minutes. So basically, so this is in Hong Kong. The importer, they create the the purchase order in the HSBC platform, which can be validated by exporter using Standard Chartered's platform. Cross-validation across different platforms. You can take the finance, and once the invoice getting created, the invoice in the exporter's platform can be matched to the PO created by the importer in the importer's banks. Cross-validate. But people say, okay, you can still collude, right? I mean, if the buyers and sellers are the same company, or they can just collude. They can do a lot of things, do bad things together. But what do you do? So we create a trade finance network in Hong Kong, actually in some other parts in China, and we actually create a trade network for China customs. So as trades are getting processed in a cross-border trade, the data are being created in 2 different networks, but they're all created in the encrypted form. So after the trade finishes, and the vendor take the purchase order, the file, and wants to use it as approved to get finance from the bank, bank will only need to be the member of the two networks. So they can take the encrypted data of the 2 networks and run this 3D ZKP check to make sure if they match in zero knowledge. And again, check if they match in zero knowledge. If these 2 numbers do match, it's going to be very expensive for vendors to. It's going to be easy for them to collude between buyers and sellers. But if you're also getting the data from logistic company, from tax department, that becomes very, very expensive. And that's basically my 10 minutes brief on our technology.
Thank you. Our next one is
Testing. So I am technically an employee of Figure, but primarily work on our back-end technology product called Provenance, and I'll explain the relationship between the 2 companies quickly. So Figure is a consumer lending company. We do home equity line of credit loans, mortgage refinance, and student loans. So you could go to figure.com right now and refinance your student loan and probably get approved by the time I finish talking. Figure sells most of its loan products to end buyers on the capital markets side, who are investment funds and other banks and financial institutions. That process of selling a loan to banks is actually very cumbersome and inefficient and process-laden, and I'll walk through why that is more in a second. So we also built a back-end technology platform to automate the process of transferring those loans and transferring other financial assets between different parties. And that's based on blockchain technology. We've financed over $700 million in home equity line of credit loans to date and sold all of them to end buyers on this platform. We have a bunch of major financial institutions using it, including Experian, Fortress, and a bunch of other buyers. We have a $1 billion warehouse facility financed by Jefferies. So all that is actually being done live on the platform today. Provenance does have a digital token that represents the equity of it. The model is really boring. People pay fees for using the platform in normal US dollars, and those fees are distributed to the holders of the digital equity. The plan is for Figure to sell that stake down over time to other institutions that will be using the platform and basically divest ownership of Provenance over time. And this model is actually fairly common in the finance world. The DTCC, which is where most stocks are currently cleared, operates in a very similar model where it's owned by the institutions using it. So that's actually something that people in the business world are fairly familiar with. So the process of selling a loan is actually incredibly complicated and incredibly manual today. When you originate a loan, so you go to SoFi.com or Figure.com and sign up for a loan, that loan then gets moved between a bunch of different parties. And the process of moving that loan between each party requires literally mailing a box of physical papers to different parties, and then sending them an Excel sheet that summarizes what all that box of papers says. And if they want to make sure that they've received the right paperwork that actually says what it's supposed to, they then go and open up that Excel sheet and open up that box of papers, and they look between what the box of papers says and what the Excel sheet says, and stare and compare is what it's typically called. And in the life cycle of a loan, it actually changes hands multiple times. After originating the loan, a lender typically sells it into a warehouse facility where it's stored temporarily, and then it's then transferred to an end buyer. After that, it can even be packaged into a securitization and sold on to end buyers again. At every hop in that process, the box of papers can potentially move to a new custodian, and everyone in the buying those assets has to look at the Excel sheet, compare it to the paperwork to make sure they actually understand what they're buying. So that's the state of the world today, and is extremely inefficient. So we built the technology platform specifically to address and streamline this whole process. So we use a ledger based on Hyperledger's Fabric to record the documents when they're originated, and then have a complete record of transfer for each step of that process. And so we're basically exploiting 3 properties of blockchain technology, or that are associated with blockchain technology. The first is the concept of creating a unique copy of a digital asset. And if you think about it, at the end of the day, Bitcoin, the blockchain piece of Bitcoin is really just a scheme so that you have unique copies of dollar bills that someone can't just copy paste and send to multiple people. So preventing the double spend problem is extremely important in this in financial markets. You don't want someone to be able to sell a copy of loan to 2 people. And that's why most of these documents are still transferred as physical pieces of paper rather than digital files.
What defines ownership of a loan?
So for different assets, it's different pieces of paper, essentially. So for a primary mortgage, the deed to the house is extremely important. And that's what, if you actually go to a court and try to repossess the house or try to sell the house, that's the piece of paper the government says means you own the house.
A physical holding of a piece of paper, or like wrapping the paper at some depository of the
Logistically, it's deposited at an institution typically. So custodians are a type of financial entity that most people leave all these pieces of paper with. So stock certificates, for when there's still physical stock certificates. There's a company called MERS that stores most deeds for mortgages because it's logistically challenging to actually move them around. So most of them are stored at MERS, and then you pay MERS a bunch of money to transfer them between different accounts. And so for each asset, it's different, but this is the same problem persists across a bunch of different asset types. So 1 is the unique digital document. 2 is digital signatures to verify the history and authenticity of data. So when part of the diligencing a loan packet, where you're looking through the Excel sheet and looking at all the paperwork, is making sure all of the data on the Excel sheet is correct. And that's the borrower's credit score from Experian, that's the proof that they own the house, the appraisal of the house, et cetera. And so if you have the provider of that data digitally sign when they send it, so if you have Experian digitally sign the credit score they're sending, and then log that with the file, it dramatically reduces the amount of diligence you have to do to go back and say, hey, Experian, is this actually the credit score for this person, et cetera. And then the third thing is being a efficient record of ownership. So you actually have a complete audit trail of who has owned this asset at what time, and you can look through and actually see the end owner of the asset. The other piece of the architecture, so that's all handled with a fairly standard Hyperledger fabric. And it's capable of running smart contracts, so you can actually encode more complex logic into the concept of the loan. Like stocks in a corporation are very simple. One share of Apple is equal to one other share of Apple. Every single consumer loan is different. It has a different collateral underneath, it has different terms, et cetera. So it's very hard to just easily trade these assets without having some sort of underlying logic that understands how those assets work. The same is also true for private stock in corporations, where you have a bunch of different share classes that all have different shareholder rights and payout structures, et cetera. The other thing we've done is connected that the infrastructure on the blockchain to an omnibus bank, and so the smart contract infrastructure has the capacity to move cash between accounts in the omnibus bank. And we did this because it turns out most institutional buyers that are transacting this want to transact in US dollars. They don't want to transact in some weird cryptocurrency or some weird token. They like US dollars, that works pretty well. But it's very efficient to to be able to move the cash simultaneously with the assets. In the traditional process, people, you typically transfer the assets, so you'll mail the box of papers to somebody else, and then they will wire you money completely separately, and the accounting department will go through and do reconciliation and make sure all of the flows add up on both sides. So by tying the smart contract infrastructure to an omnibus bank, it lets you move the cash between different accounts at the same time as transferring assets and have the record of all that movement tied together and stored neatly in one place. Yes?
Do the parties keep balances in this bank permanently, or do they just put in the money and take it out just to facilitate this one transfer?
In practice today, they'll keep some balance in the account, but then transfer it to their primary bank account. This is not the optimal solution. If you're going to build the system from the top down, you could do it differently with escrow accounts or other means where, as long as the money flows through an account that the smart contract is able to see, or the blockchain infrastructure is able to see, you essentially accomplish the same thing. We did this primarily for a combination of regulatory and ease of use.
So you've done from America with the Union API, that will be sufficient.
Exactly. And we actually chose our current omnibus bank because they're one of the few that has an API sophisticated enough to do this. We've had conversations with so many banks, and very few have an API that actually lets you do all of the functions we need. Yes? Yeah, I have a question about the integration between the bank and the ledger. So where is the software running that tells the bank to move this money from this account to this account? Yeah. Does the bank look at the ledger and do that automatically, or is there something like server or just Hyperledger issue API calls to the bank? How does that work? Yeah, our implementation of Hyperledger and the surrounding infrastructure issues the API calls to that to the bank account. And is there anything in there where oh, that was an accident, that is there a way how is that system running? Yes. So on the architecture side, it's a permissioned network. So we know who everyone on the system is and have done KYC on it. And because there's a entity that's actually overseeing it, you can go through and undo transaction and transfer an asset back if it was done incorrectly. If somebody hacked your private keys, we can go through and restore and undo that transaction. There'll be a record that was done and essentially have a record of why it was undone, but it's the sense that if you lost your private keys, it's irrevocably gone is not as big of an issue in this sense because it's a permissioned network. Okay, I have questions about where the credentials to do that, but I think yeah, and yes. Yeah, and so in the architecture quickly, this is the basic architecture. The last point is very similar to Frank's architecture, because of data storage requirements, the actual documents are stored on a user's sort of client environment, and then hashes of the documents and of contract executions are committed to the blockchain. And so when two parties are transacting, both will run the same smart contract and commit a hashed output of that contract to the blockchain rather than the individual document, because people care very much where all of their secure data is being stored. So that's a decent summary.
A lot of things that a cryptographer, right? Some of us probably didn't know even that I'm to that level. Or it's just something that we have to trust. And this is even become a more important thing when some people jump in with their real business line with you guys. How do you deal with those things?
Yeah, and I think that's a great segue into the strategy Figure and Provenance have taken. Is one of the challenges of building a platform that connects different parties is you have to get all of the parties on at the same time, or else no one can do anything. So you need buyers and sellers on a two-sided market. So Figure very strategically basically is the first loan originator on the platform and has said, if you want to buy these assets we're producing, you have to do it on the platform. And so you only have to convince an end buyer to start with to trust you and believe that it'll work. So you remove half of the work of trusting two different people. And so to date, we've convinced at least a dozen different end buyers to try it and buy assets from us on the platform. And now that they're on, it's a much easier sell to other originators saying, hey, there's a bunch of buyers already here for you, and trust us, try it out. It'll be more efficient for you.
How long it takes?
So we can onboarding an investor asset buyer is very quick. They basically just need to be permissioned onto the system.
No, I meant like when you first approaching.
Oh, yeah. So Figure's been selling loans for about a year and a half. So the initial socialization, I'd say, took about 6 months to get the first buyers comfortable with the platform. But once you have a couple of people that have used it and you can point to, it makes it much easier to then go to others. So in any sort of B2B market, which a lot of the blockchain for business is the first customer is very, very hard to land, but then the next customer after that gets easier, and the next one after that gets easier, and so on.
Who's your first customer?
So we do a little bit differently, right? Okay. So I think I answered the question earlier. Is we actually, because compared to the SaaS model, so the SaaS model in the 2B business is really difficult because if a business wants to use your Amazon.com for businesses, then the bank or business basically will have to give all the data to the banks and services, to the SaaS provider. So instead, we build a platform for these businesses, and we give the platform to these businesses, to these banks, so they can deploy the platform inside their own server room using blockchain, which are interconnected with ourselves. And we're selling it to more and more banks, and then we slowly start to build a network. And that's one way how we start to grow our business. The second way is we win some of the pretty big international projects, including the one led by the Hong Kong Monetary Authority, which they use their not really power, but their incentive to actually got 14 different banks to actually join the network already. And we also win the contract to build for the China Customs and some other and there's another really big one. I can't really say it right now, but if you follow us, you probably heard the news within a few weeks. And that network alone gets us about like 20 or 30 financial institutions on board. Yeah.
Okay, can I ask the last question, which is a kind of like a standard blockchain question that I would like you to answer, not in terms of the business environment where the monopoly, right, but just about the application, which is the original thinking, or people feel fascinated about this blockchain. It's about the splitting power among different participants in the network, etc. In what way that when you design your product, eventually you want to get it done, that you sacrifice that part. And do you feel like this is, you wanted to improve on it, or actually doesn't matter? Like in the end, it just, if we want to get things done, and if a centralized way is a way to solve these problems, let's just keep it going.
So I'm not sure this is specifically on decentralization, but on the transacting in US dollars versus a sort of native token, from a technology perspective, it's very efficient to be able to transact in a native currency, whether that's a e-dollar that's issued by a central bank or a native token. I think something we would like to do in the long term is be able to have the actual currency be more native to the platform, so that we're not integrating with omnibus banks via APIs and all of that.
Can I add, just clarify? For instance, you're collaborating with the credit agencies, called what, media? Experian, yeah. In what way that they kind of providing a little bit of monitoring service for you? Because I always believe that if you are in a situation where business partners, one of the business partner is actually the leader, then that, and I hope that a blockchain could put in so that we bring in some balanced power kind of very, very fundamental economic ideas. So it's not really like what kind of a dollar or payment that you're using. It's about the fact that you bring in experience so that the figure probably will be a little worried about if they just do whatever they want.
Yeah, and so I think from that perspective, a lot of big firms and industries actually understand that it's beneficial to work together and set up a mutual standard or a body that acts neutrally between them. And so there's examples of that, like the DTCC I mentioned is owned by all of the large banks and stock exchanges that transact on them, and they communally receive all the profits from that organization and have influence in how it operates. So companies are very wary of letting a sort of monopolist, that platform, sit in between all of them and extract rent. And so they actually often like having a structure like that. And so that's what we're aiming for, is having a sort of member-owned network where everyone has an incentive to improve the product and benefits from the profits it's charging.
So here's my thoughts, right? So we are sacrificing by using blockchain already. Decentralization is already part of the sacrifice. Because if I were just offer a SaaS service, then I get all my participants' data. I get the customer information, I get the transaction information, I get everything. Now I use decentralization technology to have them encrypt their own data and have them to have their data, even the encrypted data, they have a copy of the data inside their own server. Then I already give the power out. The reason, the goal is about creating an ecosystem. It's not even about creating using blockchain. It's just that using blockchain can help me to create an ecosystem because I'm giving away power. It's like you're giving stock to your shareholders so they give your money, right? You give your money so you can finance your company. It's the same logic. So using DLT in a way, we are sacrificing our control. We no longer have your data, and we can't really control you. We're just becoming a gateway service provider, but which is still valuable. But creating an ecosystem, if you want to create an ecosystem with a great network effect, then you have to give away something, and the DLT technology is the technology we use to do that.